There's a fundamental rule in investing that gets forgotten in every bull market. A great company can be a terrible investment if you pay the wrong price. Right now, we're seeing a massive disconnect between narratives, which are the stories we tell ourselves about AI, Bitcoin, and passive income, and math, which are the actual cash flows these companies generate. Retail investors are pouring billions into stocks based on hype, ignoring the valuation risk that are staring them right in the face. Today, I'm walking you through 3 specific stocks that I'm avoiding. These aren't inherently bad companies, but from a standpoint of logical investing, understanding valuations and risk management, owning them at these levels is just a mathematical error. Today, we're going to break down Palantir, Altria, and MicroStrategy. For each one, I'm going to show you the narrative, which is why people buy it, the math, why the price is wrong, and the scenario analysis, what needs to happen for you to make money. Standard disclaimer, this is not financial advice. I'm not shorting these stocks. I'm simply avoiding them, and this is the reason why. First, let's start with Palantir. Palantir is the operating system for the future of AI. It's the most important software company in the world, and frankly, that might be true. I love the product, but as an investor, you don't pay for truth. You pay for earnings. As of January 2026, Palantir is trading at a PE ratio of right around 400 times earnings. Let's pause and really think about that number. If you bought a local coffee shop that earned $100,000 a year and you paid 400 times earnings for it, you would pay $40 million for that coffee shop. You would need to run that business for 400 years just to make your initial investment back. Seeking Alpha gives Palantir a valuation grade of F for a reason. The price to sales ratio is hovering near 60 times. Historically, the S&P 500 trades at a 2.5 times sales. High growth tech trades at around 10 to 15 times sales. When you pay 60 times sales, you are mathematically assuming that the company will grow at a hyper exponential rate for a decade without a single stumbling block. Let's play out the bull case. Let's say Palantir grows earnings by 50% every single year for the next 5 years. That is massive growth. In 5 years, their earnings would be 7.5 times higher than today. But if market sentiment shifts and the investors decide Palantir should trade at a normal high growth multiple of like 40 times earnings, think like Microsoft or Nvidia, the stock price would still be lower than it is today. This is called valuation compression. You can be right about the business booming, but lose money because the multiple shrank faster than the earnings grew. It's just a risk I refuse to take. Now let's pivot to the opposite end of the spectrum. Altria. It pays a massive 7.4% dividend. It's a recession-proof defensive stock. This is the yield trap. Many new investors see the 7.4% yield and think it's free money. But logic dictates we look at the source of that income. Altria's core product is cigarettes. It's in secular decline. Volumes are dropping by 8 to 10% annually. For years, they have offset this by raising prices. But there is a mathematical limit to price elasticity. Eventually, you cannot raise prices fast enough to cover the volume loss. Total return equals the dividend yield plus capital appreciation. If a stock pays you 7%, but the stock price drops 5% because the business is shrinking, your real return is only 2%. Meanwhile, you have to pay taxes on that dividend. Compare that to a risk-free treasury bond paying 4 or 5%. Why would you take on the equity risk of a company with a massive debt load, failed pivots into vaping, and a shrinking customer base just for a tiny premium over the risk-free bond? Logical investing is about opportunity cost. Every dollar I put into Altria is a dollar I'm not putting into ETFs like VIG or SCHD. These funds hold companies that are actually growing their cash flows by 10% a year. In 10 years, the grower will likely be paying you more income than your original cost basis than the shrinker, and your principal will have doubled instead of stagnated. Altria is a short-term comfort blanket that creates a long-term portfolio drag. Finally, we have to talk about MicroStrategy. This is where the narrative has completely hijacked the math. The narrative is currently buy MicroStrategy to get leveraged Bitcoin exposure. The math says you're paying a 100% markup for a commodity that you can buy at face value. MicroStrategy is essentially a Bitcoin holding company. Right now, MicroStrategy trades at a massive premium to its net asset value. You're effectively paying $1.80 to $2 for every $1 of Bitcoin exposure you get. Why? Because back in 2021, MicroStrategy was the only game in town. It was the only way to get Bitcoin in a brokerage account. But in 2026, the world has changed. We have spot ETFs. Spot ETFs allow you to pay 0.25% annual fee and you get $1 of Bitcoin for $1. MicroStrategy makes you pay a massive premium. From a logical standpoint, why would you ever pay a 100% markup for a commodity asset that you can just buy at face value? The other risk is liquidation. MicroStrategy issues convertible debt to buy more Bitcoin. If Bitcoin prices were to flash crash, MicroStrategy has a debt burden to service. This introduces blow-up risk that doesn't exist if you just own Bitcoin. Seeking Alpha quant ratings have flagged this as a strong sell or a hold repeatedly because the premium is unsustainable. Eventually, the rubber band snaps, and the stock price will fall much faster than Bitcoin itself. The common thread between these three stocks, Palantir, Altria, and MicroStrategy, is that the price is wrong. With Palantir, you're paying for 20 years of growth up front, which is a valuation risk. With Altria, you're buying a melting asset for a temporary yield, which is a business risk. And with MicroStrategy, you're paying double for an asset that you can buy at face value, which is just a premium risk. Logical investing isn't about chasing the hot ticker. It's about ensuring that the price you pay leaves you with a margin of safety. If you avoid these unforced errors, you're already ahead of 90% of the market. So, what do you think about my takes on these three? Make sure you let me know in the comments, like and subscribe for future updates, and I hope to catch you in the next one.